Well, it's been a tough year for the auto industry, but conditions appear to be improving, with South Africans once again splashing out on new cars. Latest vehicle sales numbers show a strong rise for March, and that follows good sales in January and February too. Combined Motor Holdings has just come out with results for the year to February. Joining me to discuss these is CEO Jebb McIntosh. Jebb, thanks for coming into the studio today. The results are just a short while ago, so we're still pouring through them, but on the face of it, they appear very strong. And this is something that started in the half year, because even at the half year, profit was up 129%, and that was despite vehicle sales down 30%. Now, for the full year, you had a 26% fall in national vehicle sales, and yet you've grown diluted headline earnings a share up by 207%, headline earnings a share up 212%, and you've raised your dividend to 21 cents, and that was from nothing a year ago. How have you done all of this?
Look, Stephen, we went through a process of restructuring over the previous 18 months, which we sort of completed by August this past year. And then we went onto the front foot and looked for market share. And you can see from our sales that the market was down 26% on the calendar year. Our sales were only down 4.7%. So by our estimates, we gained about 12% market share. The market helped us a little bit. It definitely started to be a little bit stronger from October onwards. And as you said, year over year, the growth in January and February did improve quite considerably.
Now, obviously, you're coming off a low base with these numbers, but
absolutely.
Can we expect to see strong growth in profits going forward from here, and obviously not to the same magnitude that we've seen over the past year?
No, sure, because if you analyse our figures, in the first half of the year, we operating profit percentage was 1%. The second half of the year was 3.4%, and that shows the magnitude of the change. And I think we can continue along those lines into this year.
Now, we've chatted about the numbers that we saw coming through January, February, March. Yes. Those were mostly the NAMSA figures that came through, but showing really nice growth in the sector, also off a very low base. You're expecting an 8% rise in sales volumes this year, so quite conservative, no great shakes. How does that feed through to your bottom line following the restructuring of the group?
Well, it'll feed through positively. And as I've said, I think we'll come back to about 3.4% margin on our total. That's our target for the year on our total turnover.
Of course, last year...
And I think the market will be a little stronger than 8%. 8% was our budgeted forecast, and we're currently forecasting a 12% improvement.
So 12% improvement.
That's been updated to 12%, yes.
And of course, during the year, you kind of switched to selling used cars rather than new cars, and that's something that we discussed often with lots of the car financiers, with ABSA, with Westbank, that they were seeing this shift. Are you seeing that shift back again into new cars and away from the used car market?
I wouldn't say we've seen a shift away. We've seen the new car market growing, though. So I would say that the used car market is more consistent, but the volume side of the new car market is definitely growing now.
Well, with people hanging on to the cars for perhaps a little bit longer last year, how did the market for spares look?
It's been consistent. I mean, people have been pressurised by expenses, by the cash position, etc. But we held it consistent and increased our profits in those areas.
Are your customers getting finance quite easily at this stage, or is that still an obstacle?
I think that's absolutely a key question you've hit on, Stephen. That the finance is the key. At one stage, at the worst part of the downturn, the banks were passing probably about 20% of the business we wrote. That's probably up between 30 and 33 and a third percent now. So it's a big improvement, but still a long way from the 55% we used to enjoy. The other factor is the banks haven't passed on all the savings, all the reductions in interest rates. We've seen that the rates are probably 2% higher than they used to be. So the 5.5%, only 3.5% has been passed on to the customer.
Is that something you've taken up with the banks?
We have taken it up, but they talk to us about their bad debt ratios, etc., and taking a more conservative viewpoint.
So when conditions are fully normalised for the banking sector, and one would hope that that would happen during the course of this year going into next year, do you think then that the full savings and interest rates, the 550 basis points, would be passed on to customers, or do you think that this is the status quo going forward?
I think it's closer to the status quo going forward. And together with the National Credit Act has made this sort of upturn, the beginning of this upturn, a little bit more difficult than previous times. But I think it's more sustainable in the long term then.
Is this something then that you have to adjust for going forward?
I think absolutely. That's why we've cut our overhead space to adjust to the volumes going forward. We don't foresee the type of markets we had in 2006, 2007 very quickly again, Stephen.
Where are you seeing life in the markets at the moment? Because of course you sell cars across the spectrum. Yes. We're talking about Fords and Fiats, we're talking about Alphas, BMs, Jags, even Lamborghinis. Who's out there buying cars? Are you selling many Lamborghinis?
No, look, I think you've hit on again a very good point. At the top end of the market, at the Lamborghini and the ultra luxury cars, still the market is tight, and the leisure market is still tight. And we foresee that the market picked up in October this year. We started to see, and I think that market will only pick up fully in September, October this current year.
Soccer World Cup coming up. You, of course, could benefit from this on a number of fronts. Yes. You have a car hire business, yes, which I'm sure would benefit. Also car sales, and people are feeling a bit in better spirits as the World Cup, yes, comes. How are you seeing that in your sales?
Well, on the car hire side, we've taken a fairly conservative view because all our cars are hired out for the period. But the problem is the shoulders, because we put a car on hire on the fleet, normally for a year. So what do you do with it in April, May, and July, August? So we've taken a fairly conservative view, but our cars are basically all sold with almost 100% utilisation during that period.
Post-Soccer World Cup, do you expect the market to maintain the buoyancy we're starting to see at the moment?
Yes, I think so. I think the used car market might be affected to a degree by the defleeting of car hire fleets. But so
it could be flooded with cars, you mean?
It could be flooded, but I think there's still a good demand for those cars, and stocks are relatively low, so I don't think it's going to be too bad, but there will be an oversupply for a while.
Do you have prospects for the 2011 financial year?
I think are very positive, relative to where we come from.
Great, well done on the results. I mean, the numbers certainly look fantastic, but thanks for coming in today.
No, thank you very much. Thanks, Stephen.